Good afternoon. It's Saturday, November 19th, 2022. It's just after noon on the East Coast. This is Robert Sin at CEO Technician on Twitter, at Goldfinger on co.ca. Start with the 5 fundamental truths of trading. I noticed that engagement around trading psychology and mindset tweets, chat comments is not high. People don't really like to hear it because I think most people are operating under the premise that they have to know what's going to happen next, and they don't really want to work on their market mindset. They want to stay right about the way they see it. And I think the older we get, the more prone to staying stuck we are. It's just harder to change. And so I say that from just an objective standpoint, not giving any emotional charge to it, just my observation of the lack of engagement, the lack of interest in the domain of trading psychology and mindset. And I can't stress enough that this is the most important part of trading. So I'm just going to keep going at it, and whether you like it or not, I guess you can just tune me out if you don't care for it. But I feel it's very important, and I'll keep trying to add value in any way I can. So anything can happen. Anything can happen. And look at just what's happened in 2022 in the markets, and look at the FTX scandal, the crypto market going to trillions of dollars in valuation in 2021, and now on its way a lot closer to zero than a couple trillion, right? So anything can happen, and there's a lot we don't know, and there's a lot we don't know that we don't know. So stay humble, keep an open mind. You don't need to know what's going to happen next in order to make money. I think this is the one that people have the most trouble with. Well, hold on. If I don't guess what's going to happen next, then how could I possibly make money in the market? Well, there's a few different possibilities. One is you could take a long-term view and not know exactly how you're going to get there or the timing of it. So you don't know what's going to happen next, or even, uh, you know, the second thing that's going to happen or the third thing that's going to happen. You don't know the order of how things are going to happen, but you size the position appropriately according to your risk tolerance. You have a long-term view of a particular asset, market, stock, et cetera, et cetera. And eventually it happens. You get there, but you don't have to know what's going to happen next in order to make money. Also, I could have an opinion about what I think the market should do on a given day or a given week, and that opinion could change based upon new information, based upon price action. And I could come in being bullish and long, and I could change my mind and exit, sell, and then go short and then make money, right? A lot of trend following strategies is just following the trend, not needing to know why something's happening. It just is. It's happening. And this gets a little deeper. And I think the more advanced, the more experienced you are as a market participant, the humbler you get, and the more open to being wrong you are. I think it's a good way to be, generally speaking. And accepting the level of chaos in markets, the level of randomness. There's absolutely randomness. And every moment in the market is unique. Even if it's similar, even if there's a lot of similarities, it's not the exact same situation. It's not the same market participants. It's not the same level of information flow as it was in the past, right? There's so many differences. So every moment in the market is unique, and it's never going to play out exactly the same way, even if markets do tend to follow patterns over the long term. We go through cycles, we go through stages, and that's a lot of what technical analysis is about, is analyzing the patterns, the stages, the cycles, and trying to time it reasonably well while managing risk in the process. Um, I did this Uber bull case for gold video. Oops. I did this video, when was it? October. Yeah, a month ago. I think this is the most watched, video I've ever done on YouTube, if I'm not mistaken. Could be wrong on that, but got a lot of attention. And the timing seemed to be pretty good. I think gold was trading around 1650, thereabouts, the time I made the video. Went up to 1790 last week, closed it last week just above 1750. So about $100+ move since I made this video. And actually everything, all these points still valid today. And then we have the crypto meltdown on top of it. So add a bullet point here. The economy is weakening. Inflation is dropping. Certain economies, parts of the world, are showing signs of stagflation, absolutely. And then we have the cryptocurrency meltdown, all this fraud, all these scams. The level of fraud, the number of Ponzi schemes in crypto, it permeates the entire space. And so a return to real money, to sound money, to a timeless store of value with no counterparty risk, it couldn't be a better time to own gold. I really do feel like we are entering the sweet spot. I don't think we're in the sweet spot yet, but we are on our way there. And we could be there a month from now, 2 months from now, 3 months from now. I don't know the exact timing of how this is going to play out. I don't need to know what's going to happen next, but I like gold here. I like gold. I really like gold. And add the technical structure, triple bottom, pretty rare technical pattern, but this is a triple bottom. And the thrust off that bottom has been powerful. The thrust through 1700 caught a lot of people by surprise, quite frankly. I think a lot of people weren't long gold on that thrust through 1700. I still don't think a lot of people are long gold here in any size. A lot of people are just waiting for this move to fail and go right back down to 1600. So the bandwagon is likely to become more crowded as price goes higher, just like it always happens. Just like earlier this year, I don't think a lot of people were long gold in early February around 1800. And then when we shot above 2000, suddenly everybody liked gold, and podcasts were talking about how great this is for gold, the war in Ukraine, and yada, 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 right? A lot of people got bullish above 2000, and then we dropped $400. But this is a nice setup. You have a strong technical bottom. You have a strong fundamental case, a multi-pronged fundamental case for gold right now and well into next year. Strong technical setup. It's under-owned asset. I'm going to go out on a little bit of a limb here and make a prediction. I hate doing that, but make a prediction that more institutional investors will want to increase their gold allocations into year end. So by the end of 2022, as they walk into the new year, they're going to want to show higher allocations to gold. And And so I think that we will have a nice bid, a nice steady bid in gold. That doesn't mean it's going to go up in a straight line. It never does. But I think we have a nice firm bid to underpin gold into year end. The seasonal tailwinds are also favorable for gold between now and January. I made this tweet last week. Yes, I liked my own tweet because sometimes my favorite tweets, I do like them. And it also helps you to get more engagement sometimes. GDX, this is a nice bottoming pattern. It broke out from it. Bull flag, falling wedge, call it what you will. This is a nice setup here in GDX, a very hated sector, very under-owned sector. And we have some nice seasonal tailwinds at the end of November. Then it gets a little messy for a couple weeks, and then we get a very strong uh, seasonal tailwind, seasonal bull trend into the end of the year. The final couple of weeks of the year usually are good for the gold miners and gold. So uh, as we walk into Thanksgiving week, this is a nice looking setup. As long as it's above $26, this breakout level, this key support level looks good to me. Relative strength is in above the median line in bullish territory. Force index has cooled off a bit. It's a nice setup. It's a nice setup, folks. I like gold here, and I like gold miners. If you haven't watched this video, take some time. I invite you to take a look at it. So moving on. Notice how the dollar has cooled off in recent weeks. That's been good for equities. It's been good for gold. It's been good for miners. Dollar is running the show here. And clearly some of the tightness in the dollar cooled off in recent weeks. I think China had something to do with that. But also the fact that inflation data came in softer than expected, cooler than expected. The expectations for the terminal rate, the Fed funds terminal rate, have come down a bit. Some dovish talk by some Fed speakers, including the Fed vice chair, has helped to cool the dollar off a little bit. No accident, the yen got above 150, and when the yen was above 150 to the dollar, the S&P was basically on or near its lows, 3,600, 3,500 on the S&P. We've rallied 400 to 450 points since then, as the dollar yen has cooled off from 150 to 140. That's no accident. And quite frankly, everybody hates the yen. Everybody doesn't want to have any exposure to yen. And if I look at this chart just from a technical standpoint, that this is bear flagging, it might be on its way back down to 135 or even 133, test this rising 200-day moving average. So we could be in for some more dollar weakness into year end, especially if the economic data continues to point lower and inflation becomes less of a concern. And I think a lot of signs. I mean, look at oil, big down day, big down week last week, dropping from nearly $90 a barrel to 80. So this is going to help the consumer. This is going to help to cool inflation. The supply chain woes that we were dealing with at the end of last year and even into early this year, that seems like it's completely abated. And even Barron's basically wrote a cover article talking about this Thanksgiving shopping season, this holiday sales season, and a lot of retailers have an inventory glut. They need to unload. So we're going to see prices. We're going to see some pretty aggressive sales. If you need anything, clothes, home appliances, whatever, you're going to get some good sales here this coming week and well into year end. So inflation is becoming less of a concern. That doesn't mean it's going to go right down to the Fed's goal of 2%. I think in fact, it's quite likely that inflation could stay sticky near 3%. The Fed might just become okay with it. But there's a big difference between 3% in the CPI and 9%, right? Like 9% is not acceptable and it's a crisis. 3%. I think honestly, this Fed secretly might be happy with 3% for reasons that I'm not even going to go into this video. But I think inflation is much less of a problem. That's dollar negative, generally speaking, good for risk assets. I don't have a strong opinion on the S&P, quite frankly. Uh, Historically, we usually get a little bit of a rally during Thanksgiving week. That's about as far as I can see ahead. Um, I think 3,900 probably a fair level. My inclination is to sell rallies, big rallies. I'm a seller. Big dips, probably a buyer for a trade, and don't have a strong opinion. Sorry. Now let's get into this. This FTX thing, Sam Bankman-Fried. I mean, this is mind-boggling stuff. For those who have been around a while, think they've seen everything. Well, you haven't seen everything. You haven't seen this, and I certainly haven't seen this. But I think that the main point from this blog post by Ben Hunt, and like my main takeaway from it, is that all Ponzi schemes, all scams, well, most Ponzi schemes, most scams start with a honest quotations, honest premise. So usually the Ponzi schemer isn't at the inception, at the first moment in time, isn't thinking this is going to be a scam. They usually have some real business. Like Bernie Madoff had a market making business. He was a chairman of the NASDAQ. By most accounts, his Ponzi scheme started in 1987. So he had a legitimate business in the late 70s, in the early 80s. And what happened is his business got bigger. And in the 87 crash, evidently, he made some really bad trades. He took some big losses. And that's where the Ponzi scheme that lasted for 20 years started. He needed to cover up a hole instead of fessing up and admitting his losses. He started managing people's money to cover the holes in his business. I believe that the FTX scandal probably started very similarly. 2018, 2019, it was a legitimate business. And in 2019, as a market maker, he may have actually had an edge in the crypto market because there were big inefficiencies to exploit. But as money poured into crypto, the bull market evolved in 2020 and into 2021. By all the accounts I've read, his market making business and his trading business with Alameda it became unprofitable. That his edge was arbitraged away by other market participants, and the market turned, right? So crypto peaked in November 2021. So quite likely for most of 2022, whatever investments or holdings, trades they had on generated huge losses. And this is where we are today, November 2022, with the massive hole in the balance sheet. Also, Sam Bankman-Fried and FTX took client funds to bribe politicians, make donations to super PACs, mostly the Democrats, but also to Republicans, and they did a lot of advertising. The FTX name was on the Miami Heat arena. I'm not sure how much that cost, but I think at least $35 million. Barstool Sports, $5 million. I mean, it just adds up. The money was spread around everywhere. I mean, clearly Sam Bankman-Fried knew the way to gain favor and win friends and influence people was to pay them. And so the money just went everywhere. And Madoff made political donations too. And this is what happens. So the reason why Sam Bankman-Fried is not in handcuffs now, the reason why this is not a bigger scandal, quite obviously, is the tentacles of this fraud reach deep within the power centers of the United States of America and the world, quite frankly. So a lot of powerful people, including the best quarterback in the history of the NFL, Tom Brady, is involved in this. Bill Clinton, Tony Blair, Joe Biden, everyone is involved in this in some way. So this is a big fucking deal. And the truth will come out. The truth always does. It just might take some time. And I think it's going to be a very damning moment, like a 2008 kind of moment for a lot of aspects of finance, Wall Street even, because there's Wall Street money here too, and then political donations. I mean, Nancy Pelosi doing insider trading on a regular basis in plain sight. I mean, there's just so the Federal Reserve members, governors trading S&P futures in front of Fed meetings in 2020. Everything is corrupted, right? I mean, I hate to say it, it's not pretty, but everything is corrupted and people aren't honest about their conflicts of interest, right? I mean, we all have conflicts of interest. We're all biased in our certain ways, our own ways, whether it's politics or, investment bias. We're invested in some sector or whatever it is. Lots of different conflicts, right? At least if you're honest about it and upfront about it, okay, I can evaluate what you're saying and what your bias is. But a lot of people were conflicted and not transparent about their conflicts, not honest about their conflicts, right? And so I think this is a very important moment in American history, in market history, and clearly this will change the cryptocurrency industry forever. And I just want to point this out. This is what a Ponzi scheme looks like. And there was so much of this in crypto. Yield farming, 15% annualized fixed rate loans. These loans have no downside risk. In the unlikely case we lose more than 2% over a month, we give all investors the opportunity to recall their funds and we still guarantee full repayment. I mean, guaranteed by what? Guaranteed by what? So every Ponzi scheme has some variation of this. Usually the interest rate is higher. This looks more, legitimate. It's not above the usury rate. I mean, I've seen, 40%. I've seen 20% a month. And as soon as you see that, the risk is enormous and you're quite likely not to get your money back. Binance, USI Tech. Sorry, not Binance. Well, maybe Binance too. I'm having a mental. It was called BitConnect. BitConnect. I confused Binance with BitConnect. Binance might be a fraud too. We don't know yet. But BitConnect 2018 and USI Tech, which I posted the video I made at the end of 2017 about that. It's all the same shit. It's all the same shit. Oh, okay. Jesse Felder. Excellent blog post. This is how you blog. This guy's a master blogger. 6 paragraphs. He makes a very elegant point, cuts to the heart of the matter, and that's it. This is how you blog, ladies and gentlemen. And multiple mic drops in 6 paragraphs. The truth is that most don't want to succeed in the markets as much as they want to be both thrilled and agonized by them. Boom. Couldn't have said it better myself. Absolutely brilliant sentence. And that is the truth. Good trading is pretty boring. It's pretty dry. It's usually pretty simple. And it's not thrilling. Because it was thrilling, most likely you're betting too much. You're risking too much. And it shouldn't be agonizing. Because if it's agonizing, then you're emotional. You're not thinking objectively. You're not basing your analysis on objective facts like price action, chart structures, corporate earnings, various pieces of information that you can objectively analyze and dissect. But if you're being thrilled and agonized, then you're an emotional roller coaster. That's not good trading. So this is highly recommended. This is blogging mastery. Okay, I wish I could write like this more often. Good stuff. Good stuff by Jesse. Powell suddenly is speaking November 30th. Not this Wednesday, but the following Wednesday. And he's speaking about the economy and the labor market. So that's interesting. It's interesting. It's also interesting that Jan Hatxius, sorry for the poor screenshot, but Jan Hatxius, Goldman Sachs economist, published a research note last week saying this cycle is different and talking about how basically the overheated labor market was the result of unprecedented job openings, and that core inflation can fall to, let's say, 3% by the middle of next year without a huge rise in unemployment. Yeah, it'll tick up. It might tick up to 4.5%, but it won't be 5 or 6%. It doesn't have to. A lot of these job openings, if they just vanish, the labor market will be a lot healthier and more balanced. And the normalization of the supply chain, rents. I mean, I'm telling you, I posted that anecdote, and there's more than one in the trading lab about South Florida, and my friend who was up for to renew her lease, and Eric Coffin made a joke about it, but that is actually a really important anecdote because I'm hearing it from multiple sources. I'm seeing it back in August, even September. People's rents are getting jacked up right and left. Now, landlords are basically lowering the rent increases. They're still going up, but not double digits. And they're giving more incentive for their tenants to stay. This wasn't the case earlier this year. So clearly, the rate hikes and the weakness of the economy is being felt. It is being felt. So I don't think that we need to panic about inflation like we were in August. I don't think that it's as big of a panic. Is there still inflation? Yes. Is it 9%? No. Is it more like 3 or 4%? Probably. Do I know what the future holds? No. But this is a good little page. And I like what he says about China, because if China is reopening the first half of next year, that's going to be bullish for commodities. Okay, that's going to be bullish for commodities. And it should be bullish for gold and silver, copper for sure. Obviously, Property market in China is a big question mark. Weakness in demographics, no doubt. There are some challenges. But given that China's been basically partially offline for all of 22 because of the zero COVID nonsense, and then they reopen next year, that's going to make a difference in the global economy. And actually, while it will probably be pretty supportive to copper and maybe even to oil prices, generally speaking, this should help with the supply chain challenges that we've been having. And it should actually, generally speaking, further serve to cool inflation. I know that's kind of counterintuitive for a lot of people, but I think that's the case. The market is factoring in a 5% Fed funds rate early next year already. I don't see the Fed exceeding that. So we're kind of bracing for the worst already. I think 5% on the Fed funds is very tight. I think that's going to be very tight. And while he says we don't expect cuts in 2023, I would bet against that. I would say by the end of 2023, there will be a rate cut later in the year. I think 5% is going to be very tight. And I think it's going to cause problems in the real economy. And housing is definitely going to get hammered. And by the end of 2023, my guess would be that inflation is no longer a concern. It's come down a lot closer to the Fed's target range. Not necessarily 2%, but it's going to be low enough that the weakness that they're seeing throughout the economy and housing and in labor market by the end of 2023 will be significant enough that they'll begin to ease. That's my base case. And this is all bullish for gold. That will be the sweet spot for gold. When the Fed has maxed out the tightening, the underlying real economy is suffering, and the Fed starts talking more dovish and gets ready for that first rate cut, that's when you want to own gold. That's when you want to own mining stocks. Copper got up almost to $4. It's pulled back pretty big last week. 360 is a big support level. So 350 to 360, that's big support. I think you want to buy copper on dips. You want to buy it on weakness. I think 360 is a good buy level. And if China is reopening in the first half of next year, you want to own copper. I think it's as simple as that. Pretty much say the same for silver. I think 21 is pretty good support. Maybe you could dip down to 2050. You want to buy silver on dips. Everything I said for copper, I could say for silver too. And adding a little bonus that it is a monetary metal that should benefit from the Fed sort of, reaching peak hawkishness and starting to get more dovish and sort of tapping out on the rate hikes early in 2023. 2250 is the key upside breakout level for silver. The 10-year yield. So 10 years, what you want to watch. The 2-year is, I wouldn't focus too much on the 2-year. I would focus more on the 10-year. The 10-year is putting in a big, fat, juicy topping pattern. We might have a little upside in yields maybe over the next couple of weeks, maybe back up to 3.9 or 3.95 on the 10-year. And then I'd be looking for it to start to roll over again closer down to 3.5% as more inflation data comes in and misses to the downside, shows that inflation is cooling, and the labor market starts to really decelerate over the next few months into 2023. I think we're going to see those non-farm payrolls start printing 150, 100, and then maybe even sub 100 by February or March. And that should bring the 10-year down to 3.5 or maybe even lower. Again, falling long end yields, supportive for gold, negative for the dollar, good for gold mining stocks. So we're getting into that sweet spot for precious metals and miners. We're getting into it. I'm not saying we're exactly in it, but we're getting into it in 2023. I think we'll be in it. Good piece in Barron's about retail sales and just how these retailers are going to be unloading their big inventory gluts that they've accumulated over the last year. There's going to be some big sales. They're going to be slashing prices to get this stuff out the door to unload these inventories. So the consumer benefits. Unfortunately, that's going to support the retail sales numbers staying strong, but the consumer is going to get a lot of good deals, and they're not going to feel like there's high inflation anymore. They're going to feel like inflation has cooled off. So is this like a Goldilocks setup, a soft landing? Got oil prices dropping. The retailers are slashing prices and giving big sales to the consumer. Rent increases are cooling off. I don't know. I mean, you can make a bullish case, I guess. I mean, even with the Fed raising another 50 basis points next month and probably up to 5% early next year, you can make a bullish case for stocks, I guess. I don't have a strong conviction in that, but just throwing it out there. Oil's at 80. This seems like a pretty normal price. It's not, I don't feel like I'm getting screwed at the pump anymore. I mean, it's kind of a ideal situation. Again, I don't have a strong conviction in that. I'm just pointing it out. Final topic. And this is an area where I have some conviction. So listen up. I'm long Cameco. I'm long NexGen. I'm talking my book here. Full transparency. I may choose to buy or sell anytime without notice, just like you might. But I like this setup here. Seasonality is favorable for this sector for the next couple of weeks, maybe even into year end. Charts are messy. I mean, no doubt, sloppy. But if we look at like Cameco longer term, pull it out, it's kind of bullish. It's consolidating in an uptrend, which stocks tend to do before going on another leg higher, right? So it's messy near term, no doubt. It's really messy. The 200-day is flat. It's in a range. Trade the range. You can make money if you trade the range well, like we have. But I like this sector because think about it. All that dirty coal power is going to get replaced this decade. Not next decade. It's going to happen this decade. You can bet on it. And to replace that, they're going to need a lot of nuclear. They're going to need a lot of fuel for those nuclear power plants. And that's what Cameco mines, right? NexGen, uranium deposit in the Athabasca Basin of Saskatchewan. This is the best uranium deposit on Earth that's not currently being mined. It's just sitting there waiting to get permitted, waiting to get built. The biggest uranium mines in the world generate about 10 million pounds a year. The biggest, 10 million pounds. This deposit that NexGen has is likely to produce 20 to 25 million pounds of uranium a year for more than 10 years, just based upon the measured and indicated. Of course, it's bigger than that. And the average grade is a jaw-dropping, stunning 3.1% U3O8. Okay? This is very, very valuable ore body. A very valuable ore body. There's nothing like it in the world. This is the premier asset for a uranium mining company to have. The premier. And it's not cheap. I mean, the market cap's what, 2.5 billion right now. To buy it, you probably need at least 4 billion. You might even need 5 billion. Who knows? But anyway, who has $4 billion lying around? Not Cameco. They just made a big investment to vertically integrate across the nuclear energy sector. But Cameco is going to be a cash cow over the next decade. The next decade, Cameco is going to generate probably within 3 to 4 years. They're going to have net income of $1 billion a year. This is going to be a cash cow with uranium contracts resetting 80, 90, $100 a pound, maybe even north of $100 a pound a couple of years from now. Once they get their full business going with a recent acquisition, it's going to be a cash cow. So $1 billion a year net income, put a 20, 25 multiple on that. It's worth more than it is today. Okay, I'll just say that. Okay, I'm pretty bullish. Could definitely go above $30 a share. And that's me talking my book again. NexGen is what's really interesting because I think it gets bought. I think it gets bought in 2023. I think this asset's been sitting around for too long. It's time for somebody to make a move on it. Who has 4 billion to spend, right? Who's got 4 billion USD to spend? Aha. Exxon Mobil. This company generates annual net income of more than $40 billion a year. More than $40 billion a year in net income. They pay out $14 billion a year in dividends. Just in dividends, $14 billion. So $4 billion for Exxon is chump change. They could easily invest that. And they could build this mine with their own cash. Sure, they might choose to borrow some money at 3% or whatever, some low interest rate, because their balance sheet is so strong, but they don't need to. They got the cash. Chevron, a little bit smaller, but still pretty big company, generates net income of over $30 billion a year, pays out $10 billion a year in dividends. $4 billion, chump change for them. They used to operate in the mining industry. They used to, operate in hard rock mining and exploration. And then another Canadian company, not too far from the Athabasca, Suncor, $50 billion market cap, set to generate net income of $10 billion this year. And again, they pay a chunky dividend, almost $2 billion a year in dividends. So just 3 possibilities for who could buy NexGen. And considering that these companies need to diversify away from fossil fuels into cleaner energy sources, uranium and nuclear is a natural area in which they could invest and which they likely will invest. And NexGen is the best asset and the most obvious target for them. I don't know what they're waiting for. Maybe there's another box that they want to see checked, or maybe they don't like the current leadership of Canada. I don't know. But Suncor is a Canadian company, and Suncor could totally afford it. And Uncle Warren down in Omaha has a few bucks laying around. Maybe he partners with somebody like a Suncor. So anyway, this is just me wildly speculating what might happen. Long NexGen, long Cameco, long nuclear energy. Have a great weekend. I'll see you in the trading lab.